Hi everyone, welcome to the Australian Expat Tax Podcast series. My name is Bradley Murphy. This podcast is dedicated to considering the key Australian expat and international tax issues for Australian expats as they move to or from Australia. Today I am joined by Stephanie Wickham from Expat Taxes Ireland. Today we discuss the key important Irish and Australian tax issues for expats to consider when moving between both Australia and Ireland.
Hi everyone, thanks for joining us today. So today we will be speaking with Brad Murphy of Murphy Tax Lawyers based out of Melbourne. So Murphy Tax Lawyers specialise in Australian expat tax matters. We've spoken to Brad before on an earlier episode and we're really delighted that he's decided to join us again. Thanks so much for joining us, Brad. It's great to have you back.
My pleasure, Steph. Great to be back and look forward to the podcast again.
Thank you so much. And we were chatting before we started to record there about, what would be the most appropriate thing to talk about today. And one of the things that comes up quite frequently when we talk to particularly Irish people who've lived in Australia for some time is this concept of tax residency. So today we're going to talk about tax residency from an Australian perspective, what it means, and with specific reference to the disposal of a property in Australia. So for example, if somebody has lived in a property in Australia, maybe returned to Ireland and decides to rent that property out in Australia and then subsequently goes on to sell it. So we've got a bit to get through, Brad, and thank you very much for joining us. But on the concept of tax residency in Australia, give us the DL. What's the...
How long do we have?
No,
it's not quite that bad. But I guess, Australian residency is probably a little different to a lot of countries around the world in that in addition to a day count test, there's also this more sort of behavioural and subjective test that needs to be satisfied to break Australian residency. And that would normally entail a clear and permanent 2-year move out of Australia to become a non-resident of Australia for tax purposes. So that test would apply to Australian citizens, to Australian permanent residents, so an Irish citizen that would come down to Australia and get their PR in Australia. I think it's a big area that does cause some confusion. It's got to be that 2-year minimum break, so returning to Ireland on a permanent basis would certainly be enough to break Australian residency. And I guess broadly, what that means is that is important in that once you do become a non-resident of Australia, normally your employment income would not be taxable in Australia going forward. So it's restricted to Australian source property or share income after that point. And that's why it's important,
So that's actually an interesting point. So for example, we've seen, maybe less so now, but definitely in the middle of the pandemic, Irish people returning to Ireland from Australia and keeping a job with their Australian employer. And I think we touched on this in the previous podcast, but so essentially what you're saying is if they're returning to Ireland permanently, the employment income is no longer taxable under Australian domestic rules. Did I get that right?
That's exactly right. And it's normally an area, a bit of confusion, that one, in that once you do break Australian tax residency, if you were to go back to Ireland and do your employment while you're living and working in Ireland, that employment income's only taxable in Ireland going forward and not Australia. And even if you are paid by an Australian company as an employee or contractor, that income does not actually have an Australian source. And that does create some issues. Obviously, normally if you're paid by an Australian employer, there's going to be withholding taxes applied from that income. So in terms of getting the money back, from the ATO, or claiming a credit in Australia for the Irish taxes paid, because as you would know, Steph, that income will be taxable in Ireland under the tax treaty first before Australia. So I think it's just important just to make sure before that move is carried out back to Ireland that you have that conversation with your employer, with your advisor, just to make sure you've got that employment structure correct from a tax point of view, just so there's no mismatches in timings in terms of being double taxed, or just to make sure you've got the right structure for both you and your company.
Yeah, no, that's a really good point. So practically speaking, if somebody's coming back, let's assume that they know they're coming back for more than 2 years. Is an intention alone sufficient, or does an individual need to take steps to be able to demonstrate that they are going to be away for more than 2 years and be able to show that, prove it essentially?
Yeah, that's a fantastic question. Yeah, you would need to demonstrate it with the ATO, and it is a system of self-assessment in Australia. So you would declare on your return your residency status by lodging your Australian return. But it is important that you do take some steps to demonstrate that, and that would normally involve cutting your ties to Australia in terms of if you've got a lease here, cancelling a lease, telling the electoral roll here if you're on it that you're living overseas, updating your address with your banks to your overseas address in Ireland, and also at the same time demonstrating that you've got an Irish property or accommodation over in Ireland, Irish employment, just to demonstrate that you have cut your ties to Australia and Ireland is your permanent abode, as the ATO like to use that language. Yeah.
And from the point of view as well of, I see this play out sometimes, there's sometimes a cash flow advantage I find in a year where maybe you might leave Australia and a year where you come to Ireland partway through our tax year. So acknowledging that the tax years aren't identical, but would it be right to say, you're taxed up to the point you leave in Australia at the appropriate rates? And then obviously from an Irish perspective, if you come here partway through the year, we generally find that the individual's tax rate, or what we call their effective tax rate, is a bit lower in that first year that they come, because their Irish income, or the income that's taxed in Ireland, is all taxed at a lower rate because they haven't earned a full year's worth of income and used up the full standard rate cut-off point, which is the amount of money in Ireland you can have at the lower rate of tax. Is it right to say that, if you leave Australia, you're taxed to the point you leave at the appropriate rates? Does there ever a need for kind of a reconciliation after you leave to kind of see if you've overpaid tax, or how does that work?
Yeah, that's a great point, and certainly that is the case in terms of you leave Australia, you'll be your resident on the date you leave Australia, which would mean from that point you're not actually residing in Australia going forward. So you would not be a full year tax resident, but only from the date you leave Australia. And obviously that does coincide with entering the Irish system. So you're taxed on a part year basis in both countries, which does have some advantages for sure. In that normally there'll be a refund of tax due in Australia. You would have overpaid, your employer would have overpaid pay-as-you-go withholding on your employment income normally. So there'll normally be a refund due when you file your exit return in Australia. And obviously on your side, Steph, as you enter the Irish system, there'll be obviously less income in our Irish tax year. So you can, I guess, work the two tax systems there to your advantage as well in that regard. Yeah. It's a really good point for sure. Yeah. I think, and that's, sorry, go ahead.
No, sorry, my point just was there as well, that I suppose you disagree with me if this point isn't correct from an Australian perspective, but I suppose generally speaking, when we see people coming back to Ireland and, maybe they've worked in Australia up to the point that they left, and then they come back to Ireland and they get a new job here, my comment would be, there isn't a huge amount of complexity in that scenario most of the time, so probably my comments around, residency and the complexity that it can sometimes give rise to, it becomes more relevant, doesn't it, when we see people who have non-employment sources of income, or, for example, income in Australia that will continue after they leave from a passive source, such as a rental property or shares. Would you agree with that, generally we see the employment situation isn't the most complicated one if you're starting an employment in Ireland with an Irish employer and you cease one with an Australian employer the day you leave?
Yeah, absolutely, for sure. I mean, I think the employment situation, is not overly complicated. It's just making sure you get the right advice and the right accountant to help out in that regard. But where we see, I guess, the biggest issues in terms of big mistakes being made, I guess, is Australian property in particular. And the biggest one is there's been a recent law change in Australia a couple of years ago that has now denied Australian non-residents access to the main residence exemption if they sell an Australian property. So what is quite common, an expat would come to Australia, buy an Australian property, live in it, and they sell that home from overseas. They'll pay full tax on that if they're a non-resident when they sold that property. Whereas if they're an Australian resident when they sold it, they'll get the main residence exemption with no tax. So it's really important to think about that. If you do move to Australia, buy a property here and you live in that home, trying to sell it while you're an Australian resident is really, really important.
And what's the side point from the tax, but what's the market like there, Brad? Because I know you guys had like a big lot of activity during COVID.
This is another good point too. It's the market boomed during COVID. I think it's probably the same over in Ireland as I understand it. and now it has fallen away quite a lot in the last 6 months with rising interest rates. So I think this rule always catches people off guard, because obviously a move back overseas normally comes with a bit of a rush, bit of haste, bit of a last minute type, job offer or something, or family reasons. And often, obviously, the time to sell a home in Australia, it does take time. It often can take a year, and you want to make sure you get the sale right, so you're getting the best offer on your home. So I think that's a real key one. I think if you are looking to move back to Ireland, you've got an Australian property, to allow yourself plenty of time to sell it, and to plan on just being a resident of Australia when you do sell it. Because you've got the option too, one more point which is relevant here, you can rent out that property for 6 years and retain the full main residence exemption in Australia. So you could, in theory, go back to Ireland for up to 6 years and come back to Australia and re-reside in Australia and sell it and retain the full exemption. So that's an option too that a lot of taxpayers do take advantage of. But I think this is really important, just to really plan around that before you do make the move back. Because there's also withholding tax too, which is a 12.5% withholding tax for non-residents on the sale of Australian property. So and you would need the ATO to confirm if you're residing in Australia or not at that time. Right. So that's why it's important. Yeah. I assume that's got issues for yourself as well over there in Ireland, Steph, in terms of the main residence.
So I suppose, and this is where it becomes interesting sometimes, because, I generally say to people, not so much with the move from Australia, but, when you come back to Ireland, once you trigger residency, it's usually a case of thinking about what your taxes are in the context of the Irish rates. And the reason I say that is because usually the Irish rates are, if they're applicable, are higher. That's what we see most of the time. But there's always, scenarios where that's not the case. And I think the disposal of the Australian property is one where that would... for example, let's say someone is selling a property in Australia, they've returned to Ireland, they're not getting the full main residence exemption in Australia.
Yeah.
In Ireland, we would use our own domestic rules to determine if there was an Irish capital gains tax liability. And that would be with reference to our equivalent relief, which is called the Principal Private Residence Relief, which is broadly just a tax relief that exempts the sale of the family home from capital gains tax. So you could, in theory, have a situation where Australia is levying tax because you don't meet the criteria for the domestic exemption there, but it could be still fully exempt in Ireland, or only a portion of it taxable. Because am I right in understanding, Brad, if you don't get the exemption, is the full amount of the gain taxed, or is it still prorated?
Yeah, that's exactly right. And this is the real, sting in the tail. It's the full amount of the gain that's taxed. It's not prorated, which is different to an Australian investment property, which is prorated. The other concession you get on Australian property is a 50% discount long-term capital gain on investment properties in Australia. Now that concession is also denied for non-residents of Australia, but that's not on a prorated basis. So, and you lose that for the period you own the property and you live overseas. Whereas the real hit is the main residence one, where effectively, on day one, if you sell it and you're living in Ireland, you get hit with full, basically 45% tax on the gain, which is it's a bit of a disaster. Yeah,
definitely.
Yeah, exactly.
And from an Irish perspective, that would mean definitely that the Australian tax rate is higher. In other words, the individual walks away from the transaction having lost 45% of it, because Ireland would give credit if it was going to tax that gain for the Australian tax, but there's no refund from an Irish perspective of the Australian tax to the extent it's more than the Irish tax. So that's that one point alone is just crucial, isn't it? If you have a property in Australia, you're thinking of coming back, just be really aware of what the taxes will look like if you sell it after you break residency. I'm sure that's something you drive home to all your clients.
Oh yeah, I think it's probably as we were discussing before the podcast. Probably, I think the biggest issue we see with our Australian Irish clients is that particular issue, because, as you mentioned, employment income, those issues, yes, they're complex, but they can be worked out, and they're normally more sort of short term in nature, I guess. But that property issue it's a big hit and can't be reversed. So. Yeah, it does require planning well in advance. Yep.
So I hope people don't find themselves in this situation, but let's say somebody's listening to this and they think, oh, I didn't take the advice. Firstly, they should contact you. But before they do that, and while they're mulling it all over, to go back to your point earlier, there is scope to rent it for 6 years, but you must live in it again after you rent it. Is that what? Did I understand that correctly?
Yeah, exactly. And this one is somewhat confusing. So if I've misled anyone or anyone doesn't understand, please feel free to drop me an email and I can explain in more detail. But you can effectively rent the property out for 6 years and retain that full main residence exemption. So the HO says that you can rent the property out for a period of 6 years and you get that full exemption still under the main residence rule, but you must be back in Australia when you sell it. So that means that you've got the option potentially of living in Ireland for up to 6 years, renting out your Australian property, coming back to Australia and selling the property, and you still get the full exemption, which is what some people do, given the law change. And one more point on that is you can't just come back to Australia just to sell the property and then go away again back to Ireland. It must be moved back to Australia for reasons other than that sole purpose of selling the property in Australia.
Okay. Yeah.
But something to certainly bear in mind as well. Especially
really,
given the market conditions at the moment as well.
Definitely, and if you've got a large gain, and it's a big amount of money, you can understand why people would consider those drastic actions if it came to it. But yeah, you'd hope people aren't in that situation, ideally.
Yeah,
so I suppose in terms of if somebody's back in Ireland and they have an Australian, let's say they have an investment property in Australia and they're renting it out, what are the things that you generally say to them from a compliance perspective? I mean, I see this, quite frequently. I'll talk when you've done your bit about the Irish side, but I'm keen to hear what you kind of say to people when they're leaving Australia and they have a rental property there.
Yeah, look, I think the first point is just don't forget to file Australian returns for that property income going forward. We see it quite a bit where, clients or taxpayers go overseas and forget to file their Australian rental income on an Australian return. So first and foremost, please remember to keep filing every year in Australia. If it's a loss, if the property's making losses, so if the interest deductions exceed the rent, you can claim those losses going forward indefinitely to offset future income in Australia as well. The other point would be that that net income from the property is taxed in Australia at 32.5% for a non-resident, so there's no tax-free threshold on that income for a foreign resident. Now, you can do a few things to help mitigate that through superannuation contributions from that income, which is effectively a pre-tax contribution to your Aussie super, which can help to sort of, lower that tax bill a little bit. But I guess the other key point would be on sale of that property. Now, just important to remember that because it's Australian property, it's still subject to Australian tax, even if you sell it from overseas. And as I mentioned before, there is that discount of 50% as a long-term discount capital gain to reduce any gain by half on sale. But that's not available now for non-residents of Australia. So once you become non-resident, you lose that discount on a pro-rated basis over the period you're non-resident. So that's the other thing to bear in mind for non-residents having Australian rental property is that, the longer you are overseas, the less and less that discount becomes, and the tax, can be quite high on sale as well. And this is where, structuring that property, from the outset can be important as well. It is quite common, sometimes to have some family in Australia, some back in Ireland. Considering having some or more in the Australian residence name can be helpful as well, as joint tenants or tenants in common as well.
Okay, that's interesting.
Yeah.
Okay, so there's ways to structure to get an optimal outcome. And
Yeah,
I think
exactly.
to kind of maybe overlay just kind of briefly the Irish side, if we see from the same perspective, a lot of Irish individuals neglecting to file returns for Irish rental properties when they're living overseas. But it gets confusing sometimes, I think, if somebody has an Australian rental property and they've come back to Ireland and they tend to think, well, I've paid my taxes to the ATO, so I don't need to pay them again. And one we hear frequently is, well, there's a double tax agreement. And I suppose it's just about maybe correcting the mistake, which is both countries, in the majority of cases, particularly for Irish people, get to tax the income, and it would operate such that, the ATO take their slice and Ireland will work out what the tax is based on the individual's marginal tax rate in Ireland and take the difference between that and the tax paid in Australia. So it just comes back to the point I made earlier where, if you're an Irish resident, we generally say to people, think about your tax costs in the context of your Irish rate, because that's normally how it works. But I think that's an important point that tends to get missed, doesn't it? And it's understandable because it is complicated. And sometimes then when people understand that, they make a decision as to, I would be inclined to say to people, if you're thinking about renting a property in another location, it's always good to run these numbers in advance. Whether it be understand, well, what am I going to walk away from the transaction with through the life cycle of renting, or when I actually ultimately come to dispose it. Because, when you have a source in one location and a residency in a second, there's often a scenario where both jurisdictions have a right to tax the income, with obviously always exceptions, but generally speaking.
Exactly. That's so true. With tax treaties, especially the Australia Ireland one, every source of income potentially has a different treatment depending on what it is under that treaty. So, and as you were saying, Steph, there's never going to be double taxation, but it's just important to be aware that that income is still declarable in both countries, but there is a tax credit going one way to offset double tax.
Exactly.
Which does confuse people sometimes, for sure.
It is confusing, isn't it? Because even that phrase, there won't be double taxation. That phrase itself, that doesn't mean that two countries don't have the right to tax the income. It's a confusing term.
It is, absolutely. And you've got your non-domicile rules too that make it even more confusing potentially, which I'll let you chat to on this podcast, or maybe one going forward. We've got more time.
We did an episode actually the other week on domicile, and it's such an interesting area and different from the concepts that you have in Australia as I remember them from many, many years ago. I know we said we were going to talk about, Brad, was the, exiting Australia and tax on assets you might hold. What are the other things that people need to think of or be aware of if they're leaving Australia and breaking residency?
Yeah, absolutely. And this is a big one we see that, again, gets overlooked. We see is when you leave Australia and become a non-resident, there is an exit charge that applies when you do become a non-resident. Now, you can defer that exit charge. And this exit charge applies to non-Australian property. So it's really shares, so ASX shares or Irish shares or US shares that they purchase while in Australia. Or if you've got an Australian business, that's normally what it applies to. Now, I guess why it's so important is that you can make a choice to either pay the exit charge when you leave Australia based on the gain when you leave Australia. And after that point, it basically means you're outside the Australian tax net going forward for that particular asset, or you can defer it. Now, deferring it means there's no tax to pay on exit on Australia, but when you do sell those shares, you pay the tax at that point at that time. And the real sting in the tail with that is you lose that discount capital gain for the period that you're non-resident of Australia. Now, this can be a big issue if you leave Australia. Just say it's a portfolio of shares in Australia. They increase in value quite a lot after you've left Australia, and you sell them in, let's call it 5-10 years time. The tax rate on that can be high because you lose that discount capital gain for that period that you've been out of Australia. And that's why it's, again, really important to think about, when leaving Australia, it can make sense sometimes to pay the exit tax on exit. If you've got no gain, obviously you'd be crazy not to. If it's a small gain, there's still merit in doing so. And it comes down to that point you mentioned before as well, Stephanie, in terms of because you're a part-year resident likely of Australia, your income may be lower as well in that year. So it's taxed at potentially a lower rate too with a full discount capital gain. So I know we've had a couple of cases between us where we've seen that in practice, which,
It gets interesting. And I think, even just listening to you talk, the takeaway I would hope people get from this is that, sometimes I'm sure people listen to this kind of technical discussion and think, oh, this just sounds so complicated and overwhelming. But the message at a simple level is, and we've said this before, but you know, a little bit of advice in advance can go a very long way. Because as advisors, there's scenario planning that we can do to give people options. So being proactive really pays off, doesn't it? Because you know, then we can look at what's the anticipated Australian rate if you hang on to it and you lose that discount versus the Irish rate. Lots of different things we can take into account, but I think it's really good to kind of get a sense of what you see as the things that people trip up on. And it sounds like taxes are one.
Oh, exactly.
From an Irish perspective, I think as well, the concern I have with exit taxes is the treaty between Ireland and Australia. It doesn't cater for the concept. You know, there's exit taxes in Canada, and the Irish-Canadian tax treaty actually makes provision for that exit tax. So I suppose from a technical perspective, it causes a few issues, doesn't it, when the treaty doesn't necessarily anticipate these domestic taxes. So it can become complicated, and I think, definitely would recommend people take advice in advance if that's possible.
That's so true. I think the Australian-Irish treaty is a relatively old treaty that hasn't got that provision for, as you mentioned, that sort of transfer of taxing rights on capital gains assets, like the Australian-American one, the Australian-UK one, like in your case, the Irish-Canadian one. Unfortunately, Australia and Ireland doesn't have that same provision. So, can create some issues there for sure if you don't plan around it. But I think that's a good point you raised too, is being proactive. Having a consultation, I think, covering off both, the Australian and Irish side is really helpful as well. I'm not looking at it in isolation because, as we're sort of chatting through some of the issues now, I think it's really important to see the issues at a holistic level on both sides of the channel, as you mentioned as well, Steph.
Yeah, definitely. Yeah. Brad, thank you so much for your time. I know it's early morning here in Ireland, and it's later in the day there, so we really appreciate your time. And as always, I'm sure people will glean many useful hints and tips. Your email address, remind me of it, so if people want to contact you.
Yeah, my pleasure. Thanks for having me on the podcast again, Steph. It's been great as always. Please feel free to drop me an email. My email is bradley@murphytax.com.au with any questions, and be happy to help.
Awesome, brilliant. I'm sure we'll catch up again soon, and have a great evening.
Have a great day, Steph.